Good morning, everyone. I'm Vince Lancy. Today's market rundown, we're going to review again the 2007 50 basis point hike and if it's lining us up for a crash now. And we're going to go through CPI prep. Dollar, 102.92 up 7.94, I should say. 10-year yields are 409 up 2 basis points. S&P 500 is down four handles at 57.83. The VIX is 21.02 up 15. Gold is 26.11 up 490. Silver is 30.53 up 5 cents. Copper continues to get bludgeoned. 436 down 2 cents. Gold silver is unchanged basically. WTI is 74.55 off its back, up 68 cents. Natural gas is 245 backing off post hurricane fear subsiding a little bit. Bitcoin 61 spot 171, Ethereum 2400, Palladium unchanged, bid side of unchanged at 1042, and platinum 954 up 2 and change. Grains are mixed. Soy is down 3, corn is up 1, and wheat is up 6. Wheat continues to remain strong. Front page, BRICS 2024, Russia to push Petro Yuan, Enbridge combo, and Kazan. There was an article written by I can't even say his name, but he's in there. But he's a think tank person operating on behalf of the BRICS. So it's part fact, part truth, part a little bit of marketing on their part. So we took that report, we took that op-ed, basically is what it is, and we boiled it down and structured it so that it made a little bit more sense. And that's free to all. Don't be an exit strategy continues to be extremely important. Don't be an exit strategy. All right, founder CPI prep. We'll be going through CPI here in a little bit. Still creepy. About 2 weeks ago, maybe a little bit less than 2 weeks ago, we brought to your attention that the last time the Fed cut 50 basis points was in September 18th, 2007. The stock market rallied. Bond yields also went up like they are now. Oil also went up like it did until this week. That's important. And gold also went up, which it has done. And then the great financial crisis started in 2008. So I'm just touching base here, checking to see where we are in the comparison. Just for a refresher, September 18, 2007, we're having champagne and cookies. Skranka said, this is not a magical elixir that solves our subprime problems overnight, but it is a big step in the right direction to keep the economy growing. The Fed is sending a strong message that it won't get behind the curve. Famous last words, right? All right. Again, this is updated. So the initial reaction was good then. That's when it happened. Stocks are the blue line. Gold is the gold line. Stock started up and then started to chop down, still in the range. Gold went up and chopped higher. And then all hell broke loose. Gold initially dipped along with stocks, and then someone said, hey, wait a minute, that's not a good idea. And so they bought gold as stocks were going down. Interestingly, when the collapse happened, bond yields collapsed. So the thing that caused the crash, in my opinion, back then, among other things, or the catalyst was higher rates, which we're getting now, but we're not fully there. So here we are in 2024, humming the same tune. All right. Bond yields are significantly higher than they were on this date, September 18th. Gold is higher, but working its way back down. Stocks continue to be higher, and we're heading into an election. After the election, you have to be aware. Now, I'm not trying to tell you to panic and say history is going to repeat itself, but I am saying they cut 50 basis points, number one. Number two, big insiders have been selling for the last 3 to 6 months. Warren Buffett being the most notable, but not just him. I see it happening overnight. They're selling overnight in the rally, and then when the market comes in. Anyway, the reason it's not the same thing yet is because oil Oil hasn't stayed up. Okay. So it seems like this week's sell off in oil was a big reprieve for this analogy or analog. Anyway, just keep that in mind headed into the election, after the election, et cetera, et cetera. If bond yields keep creeping up and Middle East war moves eastward, which increasingly looks like it will, then stocks could have a problem. All right, CPI preview. Headline: CPI is to rise 0.1% month over month in September. That's consensus, down from 0.2%. Annually, it dropped to 2.3 year over yield from 2.5 year over year. Core rate is seen cooling to 0.2 month over month, also down from 0.3 previously. There's the grid. We're going to elaborate a little bit more on that for people in premium at the bottom. Certainly the way the market reacted last, here's our comment. Certainly the way the market reacted last CPI, if you remember, it came in hot and stocks and gold did not care. They just went up. Made it seem like it didn't care. I guess they were more worried about the recession then, right? This time, however, it does care a little more now that the recession fear is receding. Recession fear receding. Okay. Inflation fear, paranoia will return somewhat. Now, we're going to continue this and go over this in a little more detail, giving you expectations of the market moves according to Goldman Sachs as we continue on. All right. Today's data, CPI, as you know. Before we do the premium portion, let's look at some charts here. All right. I want to comment on gold. Yesterday, once again at 9 a.m., we had selling in gold. Now, I want you to assume that this selling at 9 a.m. will continue to come from the macro discretionary funds that are still selling in sell season, right? And this buying that came in, it stopped after 5 days, and that's not encouraging short term. However, and this is the dip I want. This is the dip I want. I want the market to drop, which it did, and go sideways as more of these people, more of these macro discretionary guys take profits, and the market just stays stable because there's probably another mystery buyer in here buying right before the election, right before the BRICS summit, and I think we have another leg higher if we're going to have another leg higher. The question is, will we have a little bit more of a dip below? Remember I said $100 lower? Well, we know we went is $80 lower, right? So let's see how it goes there. Silver, same story. I had some lines here. They disappeared. Again, everyone got excited. 3250, 3250. We have to stay above it. Really what we have to do is you have to look at it like this. You want a settlement over that line. You want a settlement over 32.19 at spot, right? Okay. You want a settlement over 32.19 or a trade. Well, the higher it goes, right? Remember, UBS has advised clients to start selling puts if we get to the 29 to 29.50 area. So expect to be some buying in here. I would say that this is the range here. This is the silver range right now. Again, if you're a stacker, you don't care. But if you're looking at how the market behaves, you do care. This market touches down in here. And then the election comes. Then the selling will have been done before the election. That's really good news. All right. Stay with us. We're going to do the premium section now. Supercore came in hot last month, and that's 2 months in a row, I think, which is services goods minus all energy goods, and that's going to be what everyone focuses on today. So whatever these numbers are, if these numbers come in as expected, 0.1 and 0.2, which is basically consensus, then they're going to look at Supercore. right? And Supercore has been hot because of auto insurance, because rents have not come down. You can see a chart on that respect. All right, here's Goldman's reaction grid. So if core inflation comes in under 0.2%, it's going to be a rocket ship for stocks, they believe, up 1.25%. Between 0.2 and 0.24, they think stocks will likely be up 80 basis points. Between 0.25 and 0.30, Goldman Sachs estimates 0.28. They think the stock market could go up or down 40 basis points. And then anything above 0.30, the market gets worried. So the market is really not concerned about inflation, in my opinion. Maybe it should be, but I think with oil prices dropping, it's probably not going to be as concerned. But there's your grid, and there's a little something for you to take a look at. All right. I'm Vince. Have a great day.